Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, bolting it all together. Michael, your topic for the day.
Dallas, we've done a lot of podcasts just recently on how good it is to own the great companies of Australia and the world.
Yeah.
And
it sounds very evangelist when you say it like that, doesn't it? But it's sort of, we feel so strongly about it that it probably does come across.
Well, that's why I started thinking about this. I thought we could actually be labelled as share spruikers here. And I don't want that to happen.
Yeah.
I mean, what I wanted to do today in this topic is to just to revisit how it all fits in together, how it all bolts together to get the best outcomes. I mean, buying good quality companies and holding them does part of the job.
Yeah. And like we said, it's a big part of the job, and it's very important the whole way through, from while you're still accumulating and then in through your retirement. So pretty much, if you're 55, the next 30, 40 years of your life, accumulating and owning shares in those great companies is going to do, it can do a lot of the work for you, but it can't do all the work for you, and that needs to fit into a greater plan. It's not enough to just buy and hold those companies. There needs to be strategy around how and when and how much and all those sorts of things, and that's kind of what you're talking about today, I think. Precisely, yes. I wanted to take everyone through in order of chronological order, I guess, in terms of what are the leading up to retirement, at retirement, in retirement, during retirement, and at the end of it all. Yeah. How overlaying strategy on top of that will by and large get you a much better result. Yeah. And that's I guess what we're talking about here, is that it's a combination of, and we've said this before many times, there's no one magic bullet that does it all for you. It's a matter of, as you say, bolting it all together. It's all got all the components, all those parts of the strategy that tie in together. And so I think as we go through this, just to clarify, it's that obviously this isn't exhaustive. This isn't an exhaustive list of everything. It's just an example at each of these timeframes of, as you say, in chronological order. These are the types of things that you can look at, that separate to how that money gets invested, separate to the return, separate to owning those great companies. These are things that you can take advantage of that people might not be aware of, and these are the sorts of strategies that we look at. And obviously, as you go through this, you'll explain, but it's different for every client. So this is just an example of, for some people, this is what we look at that point in time. And it's not relevant for everyone, but there are other strategies that we won't go through here that are also relevant at different times. That's right. Yeah, great point to make. So first of all, we're going to make the assumption that inside of your retirement savings, your superannuation for most people, but it can be a combination of superannuation and outside of superannuation investments. We're going to make the assumption that you have most of that money working hard enough for you. Mm-hmm. And that's why we talk about these great quality companies all the time. We know of no better asset than the great quality companies of Australia and the world to do that part of the work for you. To do that heavy lifting of where you actually need to be. So we said we weren't going to talk about it, and we're 2 minutes in, and we're back to evangelising about how good it is owning companies. Well, I guess there's three broad categories of asset that I can think of. One is cash, and that's lending money to people. And if you do that at this point in time, the rates of interest are quite low, as everyone knows. There's property. Most people own property in terms of the physical rental property in Smith Street or Jones Street or wherever it is. The liquidity issue of that is one that doesn't suit most people in retirement, in that they need so much of it. They need 10 properties, for example, to pay them enough rent after netting out all of the expenses that they can live off. And then there's shares in good quality companies. So there's so many different subsets of those broad asset
classes. However, for most of our clients, and for most Australians, the problem is they need to work their money hard enough to be able to, in the right asset, and it's got to have the right liquidity about it, and it's got to have the right amount of possibility to diversify, all those things. So we know of no better asset than the great quality companies of Australia and the world. So we make that assumption.
Let's put that aside.
Let's put that aside. So
you have to be doing that, or at the very least thinking very hard about doing that. And this is
That's right. So bolting it all together. So the last 10 years of someone's working life, and it doesn't have to be the last 10 years. If you can start 15 years out, that's even better.
But if you're listening to a podcast called Money Over 50, you're probably this is the category that you're probably in.
Yeah, look, it's a nice little sweet spot, because usually that coincides with the point in time when a 55-year-old couple at their highest income earning capacity, because they've risen to those positions I guess they've been promoted up. They've done extra study and all those types of things. They have the right amount of experience and youth. So, for a couple that's 10 years away from retirement, let's just assume earning $90,000 each. Generally speaking, we would be encouraging those people to max out their concessional contributions, which means collectively together, including what their employer puts in to superannuation, would be $50,000 at least going in each year.
And so you're talking about, so this is like while you're working, this is last 10 years.
Yes.
So you really, I think, as we've said, separate to the investment piece, one of the big things that we focus on in this time frame is that tax deduction. That's kind of I guess the broad category. And for most people who come to see us, this is the subset of that makes the biggest difference and can make as you'll see, a big tax saving over that last 10 years. But it's really about those people are working. They're as you said, they're at the top of their game, and they've done all the study, done all the work throughout the ranks. They're at their highest income earning potential generally. And so what we really want to do is make sure that of the income that they're earning over that last 10 years, they're using every dollar of that, and as little as possible is going to the ATO, and as much of it as possible is going into their retirement savings and working for them.
Yeah, absolutely. And even if the tax deduction wasn't available, we'd be still encouraging people to put in $50,000 a year, because they still have the funding problem. They need to get to that.
Yep.
They're still going to be short of where they need to be unless they do that.
Yep.
What makes it so much more attractive is the tax deductibility side of it.
Yeah.
So done correctly, a couple earning $90,000 each can put in and claim $32,900 to their superannuation. Generally speaking, their employer the standard 9.5% employer contribution adds up to $17,100 combined. They can put in $32,900. They can claim that as a personal tax deduction, and if they're on $90,000 each, they'd be claiming at a 34.5% rate. So times 10 years, so 32,900 of contributions combined, claiming that at a 34.5% tax deduction rate, and for 10 years they claim total tax returns, personal tax returns, 113,505 over 10 years.
And that's I think the point we're making here is that it's in any one year, and we've discussed this just recently, that in any one year it seems like a bit of money, and if you looked at that in 1 year, it's $11,000. It's not chump change, but it doesn't feel like it's going to make a huge difference over. But when you look at that over a 10-year time frame, if you can pick that up and times that by 10, it becomes a big dollar saving that you're looking at there. Like those tax refunds of over that last 10 years of your working life, an extra $113,500 in personal tax refunds is a huge advantage.
Yeah, absolutely. And to be fair, what we're going to do here is we're going to subtract the money so you put money in to superannuation and claim it as a tax deduction. In this case, $32,900 combined each year. Mm-hmm. You pay 15% tax on the way in. Mm-hmm. So over that 10-year period, that 15% tax on the $32,900 per year contribution over 10 years equates to total 15% tax of $49,350. We just stated that they have received personal tax returns or tax rebates or returns, however you like to pitch it. It's a check from the ATO, or it's a deposit into your account now, I think it is, isn't it, Dallas? So,
it is.
113,505 personal tax returns deposited into your account over 10 years. We subtract $49,350 in the 15% tax that you pay on the way in to superannuation. What that nets out at is $64,155 of difference. So,
so that's the real fair comparison is by doing it. As you said before, if you're 10 years out from retirement, you're generally going to need to save for retirement. You're going to need to give something up each year. If you do it this way, the difference is $64,000 over 10 years after everything's taken into account. Which, as I say, like, when you look at it as a lump sum over 10 years, it's a huge amount of money.
Absolutely, yeah. Like if it was in a brown paper bag,
you wouldn't step over it.
Yeah, absolutely. You would bend down to pick it up. You can get some sort of context around how thick that paper bag would be if it had $64,155.
That's a good point, because I think with a lot of these figures, it's easy to kind of go, $64,000, and because you're looking at it often as it relates to. You might need $1.5 million to retire. You go, $64,000, and you kind of, we look at the numerator, the denominator. We sort of divide it by, we need 1.5, so 60,000. What's the difference? And you kind of then when you break that down and go, well, $64,000, that might be 1 year's. That's all of your living expenses for a year. Like that's a huge amount of money. You can live on that for an entire 12-month period.
I think we've lost touch with the quantity of money because of electronic payments.
Yeah.
So there's people oftentimes now just don't even handle cash at all.
Yeah.
So I think more and more people are losing touch with the concept of how big a sum of money is.
Yeah, that's exactly right.
Because it's just an extra zero, or it's a comma in a different position.
Yeah. And I think that actually is a good point, because we've talked about how that relates to our spending. It's much easier to spend money when you're just tapping a card and you're not having to actually fork out physical cash. But especially with these tax deductions, it's easy to lose sight of what that saving really means. Yeah. Like if you break that down and think, well, that money getting handed to me in a brown paper bag, both, how heavy would that be? How tangible would that be? What an amazing thing, That would be a pretty amazing, it would be a very memorable day when someone handed you $64,000 in a brown paper bag. And then if you also think about that off the back of that, what could I do with $64,000? It is a huge amount of money to then be able to go and spend on things that are important to you, that you enjoy doing. So I think that's, I guess, the point of, like we said, the name of this podcast, bolting it all together, is that each of these things is not a huge number if you think of it as it relates to your $1.5 million that you need in retirement savings. But it is a huge amount of money if you compare that to how much work do you have to do to earn $64,000? How many hours worth of work do you have to earn and pay tax on to then get left with $64,000? Whereas just by being strategic about how you're saving for retirement, which you have to do anyway, you get to pick that up essentially for free.
Yeah. That's a great point that you make. It's there. It's to be picked up for free. And given that the topic is bolting it all together, so to even get ready to put $32,900 into superannuation each year, there's work that you have to do prior to that point in time.
Yeah.
We are experts at actually doing that work with people and having that come out the other end where they really don't notice the difference in their budget. They think they're going to notice the difference. They don't tend to notice the difference when we take $32,900 off them over the course of the year and put that into their superannuation fund.
Yeah. And so I guess there's another couple of examples you've got here for these tax deductions or these savings over that working life. And I think because these next couple are for smaller dollar amounts, the same applies here where it might not be a difference of $64,000, but these are still, and you can explain more what you're talking about here, but these are still big amounts of money that you would have to go and it would take you a long time to save these amounts of money.
Yes, so if in that first example we used the example of each member of that couple being on $90,000 each.
Yeah.
But what we see sometimes is we see one member of the couple being on more than that, say $150,000, and the other member of the couple being on less than $40,000. So if that's the case, there's some other things that you can tap into as well. So you can still tap into especially the higher income earning member of the couple can tap into the same tax deductible contributions to superannuation that we mentioned in the first example. They can also take advantage of actually some other government benefits as well. One of which being the spouse contribution. So if that higher earning spouse $3,000 of contribution under what they call a spouse contribution, then they get to claim a $540 additional tax offset.
Yep.
So it's like $540 tax.
Yeah.
Cash coming back to them. So over 10 years, that's $5,400.
So just to elaborate on that, these are things that we tend to look at every year, and so I think we gloss over it a bit, but it's something that a lot of people probably haven't even heard of or thought about. I think most people understand salary sacrifice or making tax deductible contributions to super. A spouse contribution is different to that. It's a $3,000 after tax contribution. If you're the higher earning member of the couple, you put $3,000 into your spouse's super fund. You don't get to claim a tax deduction on that, but what the ATO does say is you get a tax offset of $540. So it's 18%. You get as a tax offset on that amount, which is where the $540 comes from. So it's again a good example of one where, for most people, if that higher income earner generally there'll be someone who's earning more and they have a tax problem, and it's the best problem in the world because they're earning good money, but they really want to minimise tax, and at the same time, at 55, they're looking at how do we save for retirement. And so this is another big one that we're looking at is you probably want to save that $3,000 anyway. We would be recommending, well, you need to be getting that into that superannuation, which is the most tax effective environment, which we'll talk about down the track. But you're going to be doing that anyway. You might as well do it in this way where rather than just making an after-tax contribution to your own account, you make that $3,000 into your spouse's account, and you pick up a free $540.
Absolutely. And the second part of that is, these two usually go hand in hand. The other one is called the government co-contribution.
Yeah.
And they go hand in hand because the limit is roughly $40,000. They have different, slightly different taxable limits. So what I'm talking about there is that the person, the receiving spouse
the lower
actually has to have a adjusted taxable income of under $40,000. And it's not the exact figure.
There'll be some egghead accountant who's listening to this going, well, actually, no, we know, again, we get it, we know for simplicity, we're just going to say the receiving spouse. So, for example, as you said there, you might have one member of the couple who's earning $100,000 a year and the other member of the couple who might only be working part-time or is on a lower income job, and they might only be earning $30,000 a year. So these two are basically contributions that the lower income earning spouse can receive.
Yeah, so if the $1,000 goes in as a personal contribution, is not claimed as a tax deduction, $1,000 contribution goes into the lower income earning spouse's account, then they also would generally qualify for the government co-contribution, which is the government putting $500 of contribution into their superannuation fund. This is a confusing one because you don't have to be a member of a couple to take advantage of this.
Yeah.
Second part. Yeah. So first part, spouse contribution, denotes that you have to have a spouse to make that contribution.
Yeah.
That spouse, here's the confusing part too. It doesn't have to come out of that spouse's bank account. So joint bank account, $3,000 goes in as a spouse contribution, which if it's going into a pooled superannuation fund or a standard superannuation fund, there's usually a separate BPay code for that. It's called a spouse contribution code. So $3,000 goes in from a joint bank account. You have to be a member of a couple. The person that claims that is the higher income earning spouse, it has to go into the lower income earning spouse's account.
Yeah.
And that lower income earning spouse has to earn circa less than $40,000 a year in income to take advantage of that. Part B is, we shouldn't call it Part B, it's separate, completely separate.
Yeah.
Someone single or as a member of a couple, and again less than around $40,000. These figures slightly different for both of these, so I'll just say it's around $40,000.
Yeah.
But if that person puts in $1,000, again from a joint bank account, from a personal bank account, wherever it comes from, it doesn't really matter. They put that $1,000 in as a personal contribution to their superannuation. They do not fill out a notice of intent to claim a tax deduction form, so they don't claim as a tax deduction. What would happen is that they would get a $500 benefit from the government. The government would actually make a contribution to their superannuation fund of $500 after they've completed their tax return.
Yeah, and I think that's the again, like you said, those two tend to work in together, and so for the purpose of, if you're a lower income earner and you're a member of a couple, you're eligible for both of these. So again, in each year, a $500 benefit doesn't seem like much, but you get your $500 benefit there, you get your $540 benefit there. You do that over 10 years, and it's essentially a benefit of $10,400. Again, if someone handed you at retirement, someone handed you a brown paper bag with $10,400 in it, you'd be pretty happy about that.
Yeah.
I think just to wrap this up, potentially, we use the example of what we actually do for our clients in sort of May, June of each year as their end of financial year review, because you spoke before about the BPay codes and all that kind of thing. This is, like you say, bolting it all together. The output that we tend to give our clients who are accumulating for retirement is that if you've got a couple, and again, to go back to the example where there's one that's earning a higher income, one that's earning a lower income, what we normally do is get information about their taxable income for the year, look at that and go, okay, well, one member of the couple is earning $90,000, so they're on track to receive roughly employer contributions of $10,000 for the year, but they're going to have relatively high taxable income. They could make about a $15,000 contribution into super. So that would be part one of that is let's make those before tax contributions of $15,000 into the higher income spouse's account and claim a tax deduction on that. That gives a tax refund of about that $5,000 there for that person. The receiving spouse, the lower income spouse, they don't really have the same taxable income. They don't have the same tax problem. However, what we could do is say, what you want to do is make a $3,000 spouse contribution into your account plus a $1,000 after-tax contribution and get that benefit of $1,040. So essentially what we'd be recommending at that stage is to say, look, you make $15,000 into this account, you make $4,000 into this account, and it's $19,000 that, as we said, you need to be saving for your retirement anyway, so you want to be saving that $19,000. By doing that, you get a total benefit of over $6,000.
Yeah, I'm glad you mentioned that, Dallas. We do that in May and June every year with our clients because by the start of May, we really know 10/12 of the full financial year,
and what that
story.
Like,
And people's situation tends to change too, doesn't it? It's like a lot. So, we would have sometimes a member of a couple, and they're both earning $90,000 each.
Yeah.
And then by the time that May-June meeting rolls around, we get the updated taxable income figures, and one member of the couple is only at $30,000.
Yeah.
And pick up the phone straight away before we have the meeting with them and say, okay, we expected this to be a lot higher at this point in time. Oh, no, for whatever reason, we decided to resign from that job and we still haven't gone back into the workforce or anything like that at this point in time. So,
which normally would be encouraging clients to tell us that 6 months before.
6 months before, yeah.
But
it's funny, and I mean, a lot of people do tell us that straight away, but people are busy as well.
Yeah,
so sometimes we're only uncovering at that point in time.
Yeah.
And there's also business owners as consultants that we have as clients. So
they really don't
consultants
know.
We have no idea as to what income they're going to earn for the year. I have a client who's a consultant, David, in Brisbane. He's also in the Army Reserves. So we expected his taxable income to be a lot higher than it was. But what had happened is they warrant him full time in the Army Reserves. He's a former officer in the Australian Defence Force. So he's now a consultant. But they essentially took him full time with the Army Reserves now. That's tax-free income.
Yeah.
So when it rolled around, he had very little taxable income in May and June of one particular financial year. So there's all these different types of scenarios.
That's our job.
That's our job. Is to actually, and I think to bolt it all together, and say, okay, well, this is unique to you in this particular financial year. This is the best way we can pivot and actually pick up as many tax deductions as you can and other government benefits.
And I think that's, I guess, what we might do is we might break down the other parts of the chronological order in a separate podcast, because we're sort of going into a fair bit of detail here. Yep. So, but to wrap up, I think that's sort of the key there, is that it's like a lot of things we say, this is a work in progress. Bolting it all together, it's something that happens, and it's our role, and it's something that we do with our clients every year. And so that's the same thing that when we're recommending things to our clients, or if people are out there trying to do this themselves, it's not a thing that you get right once and forget about. It's really a matter of every year you've really got to go back to it and look at, am I taking advantage of, in this last 10 years of my working life, I want to be saving for my retirement. Am I taking advantage of every single tax saving? Is there any new legislation that's popped up that I can take advantage of? Has my situation changed, and does it mean that different tax savings apply to me? Have my goals changed? I'm focused on different things. All of these things, I guess that's what we talk about is bolting it together. It's about taking all that information and making it work in together with what people are trying to achieve. And it's not about us building something that no one wants. It's about looking at a situation, and this is sort of what everyone needs to do, whether you've got a financial advisor or not, is to look at your situation and go, how do I fit all this together? How do I fit all this legislation, all of my planning, all needs to tie in service of that bigger picture goal?
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.